Most parents think the risky part of giving money to their kids is giving too much, but the bigger risk may be giving the wrong asset at the wrong time in the wrong way with no paper trail. Stay tuned to learn how to gift money to your kids in a way that is generous, intentional, and less likely to create a mess later.
Welcome to a Wiser Retirement Podcast, where we cut through the noise and bring you real, honest conversations about investing, retirement, and building lasting wealth. No sales pitches, no gimmicks, just insights to help you stop guessing and start planning your financial future.
Welcome to a Wiser Retirement Podcast. I'm Shauna Theriault, and today I'm joined by estate planning attorney Arun Gupta. Today we'll be discussing how to gift money to your kids without tax problems. Exciting, yes. I've been getting this a lot and talking about gifting to kids. And I don't know if it's the great wealth transfer and clients are getting inheritances and they're wanting to. I feel like more and more clients are wanting to gift money to their kids.
I think kids may need it more these days than maybe they did back in the day.
Well, that's true, because it's like, everything's cost more money. And it's like, but clients are saying things like, I want to see them enjoy it now versus that when I'm not here anymore, or, they inherit it when they're like 70s or their 60s and they don't really need it as much,
They think they don't need it as much. Yes.
Exactly. So I just feel like it's more and more, and I think there's a lot of misnomers, but we talk about this a lot and we'll go through different things, but there's different ways to gift and ways that can help with taxes or just smarter ways to gift. And so we can talk about all of that. So I think typically, where we're seeing, I feel like there's, just gifting cash over the exemption, which we'll talk about, buying homes, doing loans, like ways to structure things. So I really want to get into all of that. I think the first thing is, you can gift annually $19,000 per person per year.
Yes, per person per year. An individual can give it either to a person. If you're a married couple, it's double that. If you give it to a trust, that counts as a different entity.
Right.
And that annual exclusion, I think it's been $19,000 for the last 2 years. And we'll see where it goes. Yeah.
So basically it adjusts for inflation each year and they round it up to the next 1,000 when it gets above, I guess, the 500 mark. And so that's what's been happening. And so to your point, you can gift $19,000 a person. And so, and what that means is you can write 19,000 to one child and their spouse, their kids, et cetera. Or you can gift split with your spouse too. So you can actually give more. And so I think, this is where some confusion is too. It's like, okay, what about like when they're in college and you're paying for their stuff and it's like, okay, but I mean, I guess that's support. That's not really gifting to them. It's more like you're paying for their food, you're paying for their stuff, you're all of that stuff, right, too?
Yes. And then it also, how you're paying for it also, and to what, if you give somebody cash and then they turn around and do something with it, that's probably not going to be as clean as if you are using that for a direct expense.
Right.
There's a lot of ways to do these in clean ways that are not complicated, which in turn will save a whole lot of complications down the road.
Yeah. And so then it's like, okay, what if you want to gift? So this is what we talk about sometimes too, and we'll just get it out of the way in the front end. It's like, okay, you can gift $15 million a person during your life. Right. Or 15, a person has 15 million they can gift either through the estate or gifting, through death or through gifting through their lifetime, et cetera. So even if you give somebody more than $19,000, that doesn't mean it's going to be taxable. It just reduces your $15 million.
Yes, that's right. And, if you cut someone a check for $20,000, that's $1,000 over the annual limit. So what you would do would be file a gift tax return, and you're using $1,000 out of your $15 million lifetime exemption. Right. Now that's pennies when it's $15 million. Now it hasn't always been $15 million, and the estate tax exemption has gone up and up and up for the last 25 years, doubled when Trump became president in 2016, and now it's permanent. So right now, that's not really a zone that most people are going to approach. However, we don't know what it's going to be like in 20 years,
Right.
in 30 years. The exemption could be reduced to $1 million, right? And that's when some of these gifts now may have some more consequences then. But generally speaking, most people aren't using that number to guide them with their gifts. But what they're doing is just writing the gift and then not thinking about it, and that can create problems. And the way you do that, what assets you give, there's a lot of layers to it.
So if somebody goes over the 15 million, which most people would not, then it becomes a taxable gift immediately.
Correct.
And the recipient doesn't pay that. The person paying, giving the gift pays that.
That's right.
So in other words, if you're going to give them $17 million because you're using your 15 million and $2 million's above, then the giftor
correct
is the one paying the 40% on the above the 15 million.
That's right. If it's during your life and you're the donor, you're going to take the tax hit. If it's after you die and it's through your estate, your estate would pay it before your beneficiaries.
And again, most people are not in that situation, but
most people aren't. But again, we don't know what'll happen. And estate tax planning was you see a lot of documents now where clients sign their wills and trusts in mid 2000s, where the exemption was a little hazier and it affected more people, right? So, generally speaking, making a gift and filing your 709, your gift tax return, is not that complicated. And if you've got right now, you got a whole lot to play with, $15 million. If you are going to give a large gift, you should think about. Well, you should file it anyway, but there's other benefits to filing it and keeping things clean. There's if you report it and nothing happens with it, right? Then it's the IRS is not going to go back and look into it, right? If you give $1 million right now and don't do anything about it, don't report it, 10 years, 15 years later, that can come back into play.
Right. So, I think the biggest thing when I hear as a financial advisor or planner, when I hear somebody say they want to do gifting, it's like, okay, how does that work with your plan? I want to make sure that the client has enough money.
Yes.
So it's like, if you start seeing that their projections and you're running and it's like, they're going to potentially have, so there's a couple, it's twofold. It's like, you have excess that you could spend more, but you're not. So that could be used for, future healthcare or gifting or whatever. Or if I'm running projections and I say, ooh, your estate is projected in 20, 25 years, 30 years to be above the exemption. Maybe we should start gifting now to start thinking about reducing your future assets so it grows out of your estate. So it's kind of twofold there. And then I would say most clients just want to give money to the kids to help them out and to see them use it. And it's like, when they're younger and they're raising a family, doing things like that, it's having them to see them enjoy it. They like to do it that way. So one of the common things that I see, individuals want to do is help purchase a house.
Oh, that's the most common one I see with gifting.
So it's like, okay, that's complicated. It could be complicated. It's like they come up with, it's like, okay, what if we both put money in and then I don't really want my client's name on the house when you're doing that because there's liability issues and stuff. So it's kind of like, okay. So I guess, how do you think it would be structured best? And of course, obviously it depends on the client. If they're wanting to say, hey, my son or daughter wants to buy a house for $400,000, how can I help with the down payment if the limit's like 19? Or where do you normally see? I'm assuming it's with the down payment and things like that.
Exactly. It's usually with the down payment. And at the core, it really depends on, is this a gift or is this a loan? Are you expecting maybe they don't have liquid funds? Are you expecting to get this back at some point? Or are you saying, listen, here you go. Here's a gift. Well, that is the first part, right?
Well, and that's the hard part too. And I'm not trying to get in depth with purchasing a house, but if you go to buy a house and you're getting money from your parents for a down payment, it has to be a gift.
That's a gift.
And it has to be signed off on that this is a gift and not repayable, because if you're trying to get a loan,
that's right.
you can't through a
Yes.
bank, you can't say that this has to be a gift. And so if
Yes.
you're signing off, it's a gift.
And then, if you could do a lot of family loans, right?
Right.
You want to structure it. So, if you're giving $100,000 to a child and you want to give them a good tax rate and you don't care when you get paid back, but you do expect to get paid back, you can do a long-term promissory note at the lowest allowable rate that the IRS allows. They publish tables every month for a short-term loan, a mid-term loan, a long-term loan. And then you're going to get that income and it's going to be taxable.
And you have to claim it.
Yes.
Because that's a legitimate loan
Yes.
then.
Yes. So there's wrinkles to it, but if you do not expect to get paid back and you are completely fine, giving it as a gift, you can give your gift and you can file, your 709 and use your whatever is over $19,000, the excess, and take it out of your lifetime exemption and in a way set it and forget it, depending on. If you've got multiple kids, then that comes into play also, evening things out.
If you want, you don't have to.
Yes, that's right.
If you feel like I did this for one and, I want to make sure that it's equal for the other.
Yeah. And, that does come in. Most of the clients that I see do want everything to be, as equal as possible to the kids. And when it's a substantial gift, they want to equalize it in a way.
Yeah.
They can either say, I gave $100,000 on this date. I want that to be treated as an advancement on the eventual share of their inheritance.
They can reduce their share.
Yep.
And then the others will still
Correct.
get their portion of that 100 or whatever.
Correct.
Their 100.
And if you want to say, well, listen, that $100,000 gift was made in 1995 and it's worth a lot more today, right? You can put it in your documents that figure is to be adjusted for inflation from the date the gift was made to the date of death of the donor. So there's a lot of ways you can qualify it, but again, it's always up to the gift giver, right?
Right.
You don't have to make it exact if that's not
No.
what you want. If you want a child to have more than the other for whatever reason, at the end of the day, you're the gift giver. But having an understanding of it and documenting it, even if it is just a gift, that 709 with the IRS, that's a documentation of it. You should keep it in your files, a record of what you did if it's something that's very large.
Yeah. And so if you did that $100,000 gift for the down payment of the home, obviously the lender, you'd say it's a gift, it is a gift, then you could essentially report the difference. So if it's $19,000 a person, so let's say, husband, wife give their son $100,000 for a down payment, that would be $38,000. That is exempt because the $19,000 limit. And then the difference of the 100 and the 38 would be a reportable gift, basically.
That's right.
And you would just go on the 709 and it would just reduce your $15 million today
Correct.
that you can pass estate tax or gift free.
Correct.
So that is one way to do it, to just give the gift. Now, some things that parents have not considered. I had a client situation several years ago that, client lived in a state that had really high real estate prices, needed help, purchasing a home. They were very established, husband and wife out there, out west, and had kids, and they'd been married for a really long time. So our client had gifted to the husband and wife, to the son and daughter-in-law, had gifted a large sum and just decided to go against their lifetime and gift split between the two of them. But from the mom and dad to the son and daughter-in-law. Well, interestingly enough, the house was in joint name. Like I said, it was a very sizable donation or gift. Then they got divorced.
Yep. And that's it.
And it's like recorded that I gifted it to both of you.
Yeah.
It was half hers.
Yep.
All
the time.
So it's like, if you think about it, I'm not trying to scare
Sure.
people, but it's like, you have to think about too, if you're gifting to your son or daughter and they're married and it's joint name, it's subject to divorce potentially.
Correct.
So just know
all outright gifts like that.
Yeah.
If it's outright, then it's out of your control completely, right? There could have been other ways to structure it, right? If they wanted to, put it in a trust for for the son or something like that.
Yeah.
There's other ways to do that. You can gift to the son and to a trust for the son. It almost as another person, you can take advantage of that extra $38,000 if you want to do that too. There are other ways to gift also beyond just for tax savings also. Sometimes these trusts as a gift for a child that just may not be able to handle money very well, right? And you don't want to make that outright gift because you give cash and maybe it doesn't all go towards where you think it was supposed to go, right? You could create protections on that, put somebody else in charge of it. There's a lot of ways to gift beyond just. It's not just always about the tax, but that is certainly.
And that's where I see a lot of that we've talked about the trust before, like the irrevocable trust being created, because irrevocable living trust is just an extension.
Mm-hmm.
It's not the same thing. But, if you're wanting to reduce your estate because you think that, or we're projecting out of your estate's getting sizable and you want a gift, but you don't want to just leave it outright because of what I just described, or because maybe they're younger and you're not really sure, or you want to protect them, or you want to make sure it stays in the family because you want to make sure. If you're doing ongoing gifts to do wealth transfer now over time, and you want to make sure it stays in your lineage, to your son and then to their kids versus being subject to, here, I'm going to give it to you. And then if you leave it to your wife and then she divorces you or gets remarried, that's not, it's still wealth transfer, but it may not be going to your descendants.
Correct.
And so if you're doing this for planning purposes of I'm reducing my estate, then that's where sometimes we set up irrevocable trust because over time you're going to continue doing this and you want to make sure it stays within your family.
Yes.
There's nuances to that because it is a completed gift. It's irrevocable. Just like it is to a person, but now you're filing, trust tax returns.
Correct.
There's other things to consider if it needs to be that. It can be a little more complex.
Sure.
But
So
it makes
a lot
it
of
stay in the
paperwork,
family.
a lot of admin work, but you're right. It's all a cost-benefit analysis, right? If it's a huge savings, right, and keeping it within your family your value system is high on that, right?
Yeah.
It can certainly be worth it, right? Yes. Nowadays, we don't see it quite as much with the exemption being as high. And there's also a generation skipping transfer tax that is now aligned with the federal estate tax. It again, 20 years
Meaning
ago.
if you're giving directly to like a grandchild,
that's right.
That still goes against that.
Correct.
And now it's at 15 million as well. It's called GST
tax,
or generation skipping trust.
Yes.
Or tax, excuse me. So that's 15 million as well.
Correct. So there's still a lot of room to play with that. But again, keeping things within the family, generation to generation, that is part of the analysis too when you are sitting down and thinking about creating these tools. But again, right now, not the focus. But it could be one day.
Well, and there's ways around it too, where. Not around it, you can just spread it more than 19. And what I mean, it's like, okay, you can give 19,000 a person, but then you can do things like pay the education tuition directly.
Yes, that's
and that
a huge
doesn't
one.
From you to the institution.
Correct.
Or for medical expenses.
Yes, those are especially grandparents have a nest egg and they want to help out. Pay it directly to the college. Pay medical expenses directly. There's no, the annual exclusion does not apply to that.
Right.
So that's yes, that is a way to give more than the 19,000 without eating any of your exemption.
Or just helping them with school and with medical stuff because sometimes those things come up where that's the extra expense that. Medical maybe you hadn't planned on, but then helping out with school. I know a lot of grandparents want to help with education and all of that, which helps the grandchild and their child because now the child's not having to pay for college and the grandchild's getting an education.
Exactly.
So, I mean, that's a great way to do it. And you pay the institution directly and it doesn't go against the annual exclusion.
That's right.
The 19,000.
Yes.
Are there other things? I think those are the only two.
Yeah, you can't
really
do it for housing. So
right.
it's education, medical expenses are the ones where you can pay direct without having to. And again, you have to do it cleanly. If you can't, don't write a check and say, hey, pay it to the institution because the paper trail is important.
Not all financial advice is created equal. Available now, Everything Your Financial Advisor Won't Tell You, an eye-opening book that reveals what's really happening inside the financial industry and what it takes to build a plan that actually works. Because what you don't know could be costing you.
So let's talk a little bit about like the how and what you're giving. So, I have some clients who, I would just want to give them this Apple stock that's highly appreciated because, it's the gains are high on it. I just want to give that. And so
usually you're going to want to wait to make if the gift is eventually going to to go to that person. If you give it during your life, and there's wrinkles with all of this, but generally speaking, if you bought Apple stock for $1 30 years ago, and now it's worth, I don't know, $200, and then you give it to your child, their basis is what you bought it for.
Right.
And
so
then,
that gifting is whatever you paid, and it goes to them. And that's, so if they go to sell it,
then they're going to pay a huge gain based on what you purchased it at. And if you're going to give it to them anyway, and they get it when you die, and let's say it's worth, $300 when you die, right? Then their basis is that very high 300 number, right? That's going to be a much better situation for them.
Because it gets stepped up when you pass away.
Correct.
And we've talked about that before.
Correct.
So you want to look at that. But they could be in a lower tax bracket. Maybe they, they if you go to sell it to give it to them or vice versa, they could be in a lower tax bracket.
Yes.
Depending on the situation. So, you just have to look at that. But it's not, or it's like, I've seen clients where, it's like, well, I don't have the cost basis for that. So I'm just going to give it to, my nieces and nephews or my kids. And it's like, well, they don't know the cost base either. So it's new. I'm like, give that one to charity, or, if you're charitably inclined, or hold it until, if it's a garbage stock, I don't want you to hold it forever because you don't know the cost basis. We'll try to substantiate and figure out what it is.
But figuring out what it is sometimes it can be such a headache. And this is not my zone at all. I dive into it sometimes if I'm helping a client, talking to their financial advisor. But man, going back and figuring out basis is daunting to me to even hear y'all's conversations about it. But there's a lot of paperwork people have to sift through, and especially with real estate. With real estate. It gets real tricky with that too.
Yeah. And we've talked about that before, where it's like, well, you want to gift a house to them, or, do that. Well, that's where the cost basis stays with it. And, any improvements, and, that's where the nuances are, and then equalizing the estate. And you always have to look at, when you're older and you're giving away assets, you have to make sure that, you're going to have enough money to live off of, because if you end up running out of money and then you need care. And you need to go to the government for help, they're going to do that look back. So they're going to look back and say, in the last 5 years, did you give away anything? And if you did, then they may not help you.
Yeah, that's always a tough
I believe
call
it's 5
for me.
years. I believe it's a 5-year look back.
It's a 5-year look back, and it's if you can, wanting to make the gift is obviously an important part of this, but can you actually make it, knowing your needs, your health situation? It's your money. If it can create problems for you later, you really want to sit and think about if you can actually, do it. And then not only that, but that can get to a larger issue of, someone maybe expecting gifts anytime they're in a bind, right? And that that's another story in a sense that goes well beyond tax. But if a child knows that they can get 10, 20, 100 grand when they're in trouble, that may guide a lot of their decision making throughout the course of their life. And you know what? That may be okay. If you're okay with that then it's okay, right? But again, something to think about. Yeah,
so many clients are like, I want to make sure that my children, want to work and be self-sufficient, and then they get this extra. But you're right. We've seen it where, it's like every year, maybe the parent gives $19,000 as like, the holiday gift or the year-end gift or whatever. And they almost become reliant on that.
Oh, 100%.
And then what if, you
they
end up needing care?
Yep.
Right. So, they become reliant, and it's almost like just, I don't know, maybe better just to randomize it or take them on a trip, or I don't, do different things so they don't expect it.
Yeah. There's even, and then they know maybe they're sucking up to you because they want to make sure that $19,000 comes during Christmas. Right. And there's a whole lot of that, again, there's so many layers to it. But I can't be one to say don't do this because they're going to expect it. That may be perfectly okay.
Right. Especially depending on the family dynamics and the situation, and
yes.
It may be totally fine, but do you see often where you family wants to give, say, like a family business to children and how that works and the best structure for that.
Yeah. So that's
if they want it.
And so that's
a lot of the
thing
kids
too.
don't even want to be in the family. You know, Casey and I have talked about that. So some of you don't even want the family business. You know, it's like I want to do my own thing, or
Sure.
they're not interested in that.
Yeah. No, that comes up a lot too. You know, absent a, you know, if your operating agreement or your bylaws, you know, are silent as to it, then your interest in your business is going to go via your estate planning documents. And if a child has no knowledge of this business and has, you know, really doesn't want anything to do with it, you're also creating an issue for them too, right?
Or the employees or the clients,
there's so much, and then they may only see it as the bottom line of, now I can just sell this, right? And that may not be the best thing for what there's, like you said, employees, people's lives depend on this too, right? Structuring this ahead of time is very important. And not only that, but you can differentiate in your estate planning documents that this child share is to be funded with cash, or this one is to be funded with real estate. So you can pick and choose, you know, as best you can to, you know, kind of circumvent some of these problems.
Absolutely. So I've seen it where there's sometimes where you have a family limited partnership and you're gifting shares. That's a very complicated structure also, but that is possible to, you know, be able to transfer assets, maybe using a little bit of a discount.
Yeah. Basically the idea of it is that you're gifting partnership interests that are discounted because there's a lack of control, because it's a family business, and if you were to sell it on the open market, you're not going to get its true value. Again, it's most of the time it's a tax technique to just get a bigger bang for your buck for your gifts.
Right.
But again, it early on is when you know, I think that it's good to start thinking about some of these things to get it out of your estate so it appreciates if you can do it.
Yeah. I mean, if you're doing this to, you know, help your estate, gifting property that you think, you know, giving to your estate limits, that is, you know, you think it's going to grow, gifting property that you think is going to grow over time to get it out of your estate is a good technique to do that, to reduce your overall state tax exposure.
Yes.
And again, when I started in the industry, I believe the exemption at that point was 500, then it went to 750, then it went to $1 million, et cetera. And it kept climbing. So, you know, most individuals aren't up against that 15 million per person. So, you know, it's may not be as apparent, but I do have, you know, many clients who want to do gifting to kids and, you know, the limits, or I see this too. I see a situation where it's like, okay, maybe a parent leaves, you know, a bank account or one asset to one child, and they want to make sure that they spread it to the heirs.
Yeah, that's usually a no. You're creating problem. Now the person that is in charge of making everything equal to everybody else, they've got gift tax consequences.
Exactly.
And if they're on a joint account with you, it's actually not anyone else's money. It's theirs, and they don't have to do it. There's lots of complications with that. And, you know, people just putting someone else's name on an account or on a deed. Sometimes a client will say, oh, if I put my child on this, then there's no probate. It'll just, you know, default to them. Well, one, you're creating a basis issue. That has some wrinkles to it, but generally speaking, you could create a basis issue there too. Plus, I think I read a study that that about 60% of deed transfers were not intrafamily deed transfers were not accompanied by a 709 filing. So you gave the gift, but you never reported it. Over half of them. I think this was probably 10 years ago in California or something like that. So the enforcement of this, again, with the IRS, it's not the biggest thing. And again, not to encourage people to do it and set it and forget it, because again, we don't know what it's going to be like in 10, 20, 30 years. Right now, the IRS, they're not the most well-organized, well-run, you know, agency right now. Maybe they will be in 20 years, right?
Too, is my
you know, and maybe, you know, they'll get their act together and they'll scrutinize these things a little bit more. And that's, you want to avoid these, doing things cleanly. It's almost always going to be worth it.
Yeah.
And the deeds, especially when you put someone else on it, you are if you have got other children, going back, figuring out basis issues, it just adds so many wrinkles to it that sometimes it's easier, especially if they're going to get it when you're gone. Just wait.
Yeah. Just wait.
Put it in
hold
your
off.
documents and
Absolutely.
not on a deed.
Absolutely. So really, other things to think about when you're gifting, we talked about divorce, maybe even liability.
Mhm.
So if you're gifting assets to your kids over time, maybe to reduce your estate, if they need the money, they'll probably use it fairly quickly, I would think. But
Probably.
they may be saving it and investing it. And this is more of a wealth transfer technique where you can reduce your estate and transfer it during your lifetime to reduce yours, and then they can turn around and invest it. You want to think about creditor situations, divorce,
Yep.
death. If you're giving, if you're giving to your child and they are married, even if they have it in a separate account, if their will says they're leaving everything to their spouse, then their spouse may inherit it anyway. So just be thinking about these things when you're giving and thinking about where it needs to go. Same thing with grandkids, are they mature enough to handle it? Are they financially responsible? Is there a way that you can transfer it to them with, because you could transfer a lot of wealth between giving to your children and then their kids and setting up specific accounts. You just want to make sure that whoever's managing it is in control of it, especially if you have minor grandkids or minor children, that it makes sense from it. And then they may have to file tax returns too.
Sure.
So even minors have to file tax returns.
Sure.
So you have to be thinking about that if you're giving money, and then, they have to file a tax return and things like that if they're investing it.
Yeah, I think, there's a theme with all of this too, is that, there's no right or wrong when it comes to all these gifting issues, right? If you make an informed decision, if you have all of this on the table and then you do it, in a sense, I wouldn't feel bad about it, right?
Yeah.
Because you can't predict the future. You don't know who's going to get divorced. You don't know if this person is going to have an illness or what's going to happen in their life. If they're in a profession where they may get sued a lot, all you can do is the best you can with the information that you have at the moment. And, putting a child on a deed and not thinking about it, that's not a good decision.
Yeah.
Even if it ends up working out, right? It still wasn't a good decision, right? It worked. The result may have not, worked out for you, but I wouldn't, I think just thinking about these and making sound decisions, talk to your financial advisor, estate planning attorney, friends, family about these and get tips on it, because these are, especially these large gifts, have lots of consequences for many other people besides just yourself and beyond taxes.
Absolutely. And so know enough. You don't have to know everything, but know enough to be like, should I pause for a second and think about this, or what's the best way to do it? And you could always reach out to us or your advisor. Just some, maybe like 5 questions to ask yourself if you're going to do a gift. Can I afford this gift without weakening my retirement plan? That's a good thing, and some clients decide they're going to look at it annually to see where are they at. Interesting conversations when husband and wife doesn't agree on the gifting. That's always,
Yeah, that happens.
It does happen.
Yeah.
And it's like, so you kind of just pros and cons with them and kind of, do the list out there. Number 2, is this truly a gift, or do I expect repayment control or influence on it?
And that's the part that, beyond loan, gift, are you going to use it, as power over that person? Is there some sort of expectation? Be clear.
Yeah, exactly. Think to yourself, am I giving the right asset, or am I creating a capital gains problem?
Yep.
So just, what are you giving? Is there an issue there? Can I do this differently? Does this gift need legal structure, such as a trust or a promissory note?
Yeah. You know, if you want to protect the person from, not using it inappropriately, or, just the mechanism for how that person gets it.
And finally, have I considered sibling fairness, divorce risk, creditor risk, and documentation? So, I mean, really, if you're looking at doing gifting, just ask those questions to yourself. Obviously you're just doing like a $5,000 gift. None of these questions come into play, other than, can you afford this? But just thinking of these questions when you're doing this or sitting down with a professional, if you're not sure of the answers, it's really good to kind of check yourself, just checks and balances.
Sure. And, I'm not don't encourage a client to keep a spreadsheet on every single little thing they give to each of their children, but
we have seen that before.
Listen,
for equalization.
These things do add up, right?
Well, because you may have a family that has like 3 kids,
Yes.
and you're giving them more for
Yes.
college, and then you have
Yes.
one of your children doesn't have kids.
Yes.
And so you're just giving them 19, whereas you're giving this family, you know, so some families get that in depth with it. It's like they theoretically need more help, or they're giving to more people over here, whereas you're just giving this. And so it's like they want to equalize that in the end.
Yeah.
Sometimes you're not required to, but a lot of parents
just
want
as long
to.
as you're giving it thought, that's what counts.
Absolutely. Absolutely. Well, good. Anything else you think we should add?
Well, again, I know that the topic is about giving it without tax problems, and certainly, that is a huge focus. But just zooming out to just what these gifts mean, I think is really important. How do you value it? How does the other person value it? What is the expectation? And doing things with a clear mind, knowing what you're doing, I think is, I guess that applies to anything, right? But still, it goes a long way for something like this, because I've seen it where the constant gift giving almost creates tension, more family problems with other siblings also. Whereas if this was just, talked about, even if it doesn't have to be with all the kids, even if it was just one child, right? It can really help, especially as people get older.
Absolutely. Yeah, it's like you're giving to this child and not this one, and there's just that tension.
Yes.
Well, thank you. It's always good to have you and your insight on this. I love the dialogue. So
always a pleasure.
Appreciate it. And thank you for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet one of our financial advisors, you can do so by going to Wiser Investor, or you can click the link in the episode notes. We've also included Arun's information in there as well. So we will see you next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.